All right. You guys still hear me?
I have you, yeah.
All right, good. All right, good. So I guess what I'm saying is I don't want to make belabor it too much, but be on the lookout for a coordinated spin because gold has rallied too much. Whether it was permitted, whether it's encouraged, whether it's bricks really getting into our markets now, it's probably a little bit of all three of those things and more. But I truly believe, look, this is my environment, meaning when really big picture stuff manifests more granularly, like that's where I excel. And I'm not saying that I'm right now, but I am saying that those are the things that most of your analysts miss because on a regular day they know exactly what's going on, and I'm always looking for the craziness, right? Well, now we're in the craziness. So, and I'm saying to you that the the Bitcoin promotions, the press going from the mainstream press going from gold's going up. Isn't that cool? Isn't that something to gold's going up? When will it break? They're calling it a bubble now. It's not a bubble, but they're calling it a bubble because it's a negative connotation. It's just the way the press works. I'm actually of the opinion now that for real reasons, if I were running the Fed, right? God forbid, but if I was running the Fed, um, I would be worried about the stock market crapping out. And here's why. Or I'd be worried about the stock market trying to crap out, and then I'd have to rescue it. And here's why. Um, we're at a point, we've been at this point for years, but we're at a point even more so now where the Fed's going to ease, and when the Fed eases, stocks and gold go up. But gold is now outperforming stocks in the rally. And the press has picked up on that. And they're talking about it over the last 5 years, over the last 20 years, over the length of the ETF since it's been around. And those things start to permeate the culture. So um, Powell was at I think it was called the Adam Smith Award. They give each other awards all the time. It's like Oscars. And he was asked a question finally that that how does he feel about gold and what it's doing? And the framing of the question was, Greenspan would talk about gold and as an inflation harbinger or predictor or indicator. How do you feel about gold's price going up? And he said, I'm not going to talk about gold. I don't talk about gold or assets in general. So like, I don't talk about asset prices in general, and I'm not going to talk about that one specifically. And he was also referring to parenthetically Bitcoin. So that interaction is the first time, whether you think it's important or not, is a different story, but it's the first time that Powell had been asked about gold. And it wasn't in the mainstream media, but it was mainstream enough to be picked up on. Simultaneously, you have the stories in Bloomberg uh, covering silver, saying it's gone from silver is rallying, what's going on, to London is getting squeezed, to and they're very close to it. Indian India is squeezing us. India retail. It's kind of like uh, the dumb Indians are buying it. I mean, they're not saying that, but I know we all know how this works because we're gold people. It's like speculators are buying it, dummies are buying it. It's going to come back, that type of stuff. And when I see the headlines, I trade the headlines too. When I see the headlines do that, I truly feel that there's influences behind the scenes. You don't have to agree with me. That that makes me think that they're going to push back. And given the history of the Bank of International Settlements pushing back, uh, even if it's just to cap it temporarily, I think that's about to happen again. So I am, I guess, without a position, right? Without meaning I'm not bullish. I'm not short or long speculatively. Without a position, I'm saying that I think that they're going to hit it next week. I do, and I think they're going to hit it next week because Thursday was a nightmare. I don't know why it rallied $100. I mean, I know why it's been rallying since August, but I don't know why it picked Thursday to rally $100, 110, $112, but it rallied. And um, it picked Friday to sell off I remember saying Wednesday or Thursday. I remember saying Thursday, maybe Friday mornings open. I said, if this is truly a trend week, then we'll close on the highs for the week. And we did not close on the highs for the week. We made a new high, but we did not close on the highs. And they're desperate to not have things like that happen. You didn't want a new weekly. I mean, you got a new weekly high close, whether you like it or not, but it didn't close on the highs. They really want to make sure that they can do everything they can, any port in a storm, to. Uh, I think they're worried about gold again. Okay, and here's why. Speaking for Powell, I would be worried about gold. In 2008, when we had the financial crisis, people like to talk about the housing bubble, and it was a housing bubble, but there were other factors. But it was a housing bubble for a while, and there were other factors that that contributed to it. And in 2008, it was right after, you may or may not remember, it was right after the Beijing Olympic Games. Remember the summer games where they had the drums and all that stuff? It was a big production. And that was also the year that Beijing, I think, or China in general, was admitted to one of the World Trade Organizations that put them on the market for global oil. They were more involved with the WTO, more involved with trade, et cetera, et cetera. And it was during that time frame that Goldman was long oil, and they sensed people were weak, and they just pushed it up to like 145. And it was during that time you had stocks going up, the Fed cutting in September of I think '07, right? Because it was starting to come off. And then the market made a new high in '08, and then oil started spiking and interest rates started to go up, and the whole thing collapsed. Now, the reason I'm giving you that story is because this story, if you're a simple economist, is different. And that story is, well, energy's not rising. We don't have to worry about no, but gold is rising. And gold is now competing with stocks. People are putting money in GLD and SLV as opposed to bonds or stocks. And it's starting to worry them. That's my opinion. This is all my opinion. And I believe that they want it to cool off. So um, I think they're going to try and sit on it next week, or not necessarily lower, but sideways to lower. I'm not bullish. I'm long like among like silver calls that go off in 2 days. So that was when I took everything off. I put silver calls on again. So one tiny small thing they're not in the money. They're just like they're destroyed because I bought them near the highs. Um, but that's what I wanted to say. I'm going to answer a couple questions and then we'll go through the charts. Uh, Britt, can I comment on silver's rate of change volatility in this new phase, outperform, underperform gold? Yeah, there are two things to say about that. When silver outperforms gold, and it's an outperformer now. MSA will talk about that, and you're seeing the volatility and macro discretionaries along it. But when silver outperforms gold, people get excited. It's also, and I say this genuinely, in smaller moves, when silver outperforms gold, it's very fractal, not fractal. When silver outperforms gold, it's usually the end of a rally. I'm not saying that here. What I'm saying is that whenever you had, remember the market, which is basically CTAs? Well, CTAs would buy gold first and it would go up. And then they'd say, oh, silver's cheap. And they'd buy that. And all the funds would buy gold first. And then silver would, and then everyone early in the game, people buy gold and sell silver. People buy gold and sell silver. People buy gold and sell silver. And then they go, oh, silver's cheap. And someone comes in and says, I think I'll buy silver. And then I'll stop out the shorts in silver. And then silver will just overshoot gold. And typically, almost like a stochastic or RSI indicator, that would show that it was overbought because gold would stop going up because it was just too expensive and then people didn't have the money. They didn't have a lot of money allocated, and silver would start to go up and it would eclipse gold in terms of performance because it's a smaller market because people like to shit on it when they're buying gold, and then eventually they cover. Happens all the time. Like Brexit was a big example of that. Gold rallied, and then Brexit happened, and then silver took off. Why? Because everyone was shorting silver to buy gold. Back then, I didn't see it that way, but I knew that silver rallying would be near the end. So gold rallies, silver rallies, and that's in the cycles of the investment cycle for precious metals. Uh, the So if you want to take that concept and widen it out fractally, um, you would say to yourself, and it's consistent with what Michael Oliver says as well. You would say to yourself that if you believe that silver is about to outperform gold, its beta is about to get a lot bigger, and it's about to catch up. I'm paraphrasing Michael when he says that. This is silver's moment to have the really big move in 6 months. That piece that he wrote or that I wrote about his work. Um, uh, he's not saying this, but I'm saying it. When you say that silver's about to get more volatile than gold and really catch up, you are also implying, going back to that fractal concept, that we could be near the end. And if you look at what Oliver says, he did say several times that it could happen quickly. So over the paraphrase is over the next 2 quarters, so call it 6 months, over the next 6 months, silver could double or triple, right? And that's just, there's nothing bearish about that, obviously. But that's also me saying, yeah, you're getting a little bit of a blow off top in the complex. So maybe we get what Michael says. Hopefully we do. We get the next blow off top 3 to 6 months, or we don't. And if we don't, that means it's the top for a while. And then you may hear Michael say something like, I'm not quoting him, right? But you may hear Michael say something like, well, short-term momentum indicators backed off. And so the big picture of my 2 to 3 times is still there, but maybe it'll move out a couple weeks, maybe move out a couple months. I don't know. But I do believe that it lines up from a bearish and a bullish point of view that when silver's volatility, now I'm going to answer your question, Britt, right? When silver's volatility increases, people think it's going to catch up. But Michael is also quick to say that it's going to catch up and overperform probably immensely. But if it happens, it could be short lived, right? So the flip side of that, the bearish side is go back and you look through history. When silver outperforms gold in this manner, it's usually at the end of a cycle. So if it's fractal, then it's a big cycle. So I would prefer now. I'll give you my preference. I would prefer that silver does not outperform. I would prefer that because I think this is going to go on for years, and I'm not long enough now. You know what I mean? So that's my bias. I would prefer that Powell would say something like, "I'm not going to cut rates," and gold and silver get hit. I really would prefer that because gold and silver would get hit, silver would get hit more, and then I'd say, "Okay, we've cleaned out all the hot, stupid money, and now let's go back in." So that's my whole story. But does that make a little bit of sense? Who was that? Britt? That was Britt, right? Does that help a little bit? Am I still here? People still hear me?
Yes.
Thank you. Thank you, Sonia. Britt, are you still there? Maybe he's on mute. Maybe he typed it in. Hold on. Oh, yeah. Short term is difficult trading. Yeah, Britt. Like short term for you, not necessarily you, but short term for many people is 1 week to 1 month, you know? Uh, um, yeah, got you, Brett. I see the messages now. Short term for me is 1 hour to 1 day. So for me, short term trading is actually good if I want to do it. I don't want to do it now, but short term trading is actually good. It's that 1 week to 1 month shit. I have no idea right now. Like usually when I get that Bollinger Band signal, what did I give you that Bollinger Band signal? Like 8 weeks ago, right? Okay. The first 5 weeks, I was like, yeah, this is fine. And after that, I'm like, I have no idea why it's doing this. So I mean, that's the sign of the market. Okay, so that's it. Uh, Scott, non-conspiratorial observation, tail significantly bid on Thursday. Sign of risk managers taking over. Friday sell-off followed. Scott, are you talking about options when you said tail?
Yeah. Hi, Vince. Yes.
So
Out of the
you
money option.
you're talking about the
So
call one, the call
beyond
tail?
beyond the 15 delta.
Yeah,
It was
what we call
calls,
the
but the
tail.
thing that scuppers the theory was also puts. But yeah. But I
So
mean
was it
it got
puts that were big as well?
yeah, which sort of which sort of undermines the non-conspiratorial observation. But the tail
No,
was significantly bid, puts
no,
and
no, no,
calls.
no. I hear you. I hear
But
you.
when
So,
people pay
so
up like that, right, that's risk managers getting involved.
yeah, it is.
Don't
It
you
is.
think?
It's,
Yeah.
yeah, I do. I do think that it's people. Yeah, it's risk managers and people front running risk managers. Um, for everyone to hear this, we're not going to go deep into options, but it's pretty simple. When a market gets near the top, when my position on a desk is near the top, when I have too much money and I have to take profits, or when the volatility is increasing, or when I think my boss thinks there's going to be a margin raise, you'll see people start to get tapped. You don't see it anymore, but people start to get tapped. It's like, take some profits here, take some profits here. Don't go home long this weekend. We don't know what's going to happen. And for various reasons, the whole community of big traders starts to behave like a herd, and what you'll see is possibly directed from the desk, possibly directed from the manager of the desk, possibly directed from anyone. It's like, you know what? Let's just buy some puts. Let's just buy some puts. You never know. And I have to tell you, as a trader on the floor, when I would see a broker would handle buy orders on the call side, and let's say this one broker, we'll call him Frank, would come in. His name was Frank Belgiorno, right? He would come in whenever he bought. 3 months later, we'd be higher. I'm like, damn. Every time you buy, this guy's right. Whoever he is, whoever this customer is, right? And then when Frank would come in the ring, when the guy was selling, I would trade with him and I would buy the calls, and Frank would look at me and go, he goes, "That's the guy who bought them 3 months ago." And I go, "Really?" And I would then buy puts and just let them be naked. So the point is, think about me as being the manager watching other people get out of their positions, and then saying, "Oh shit, let's just buy some puts." So I do believe that the counter tail, the counter skew tail trading higher is important. Right, that's it. I think some of your fund managers that have been another reason, Scott, is some of the macro funds that have sold, maybe some of them are out and they're like, okay, now maybe I'll stop buying some puts. But to
But it was both, Vince. It was that as well, but it was also the calls. So I
no,
mean,
I'll get to that in a
someone
second. Yeah, no,
they're
that's
very short, right? Okay,
that's
sorry.
total. That's totally it. Right. So there's two things that happen when positions start to roll off. So when the longs start to get out, at the I'm a long, and remember I've said this before. I need to have gold long on my books. I'm taking it off. I'll buy a crappy call so I can just say I have gold if it goes up again. Right. Simultaneously, another trader may say, another trader who sees me getting out, who sees the market getting out of its length, who sees the open interest coming in. And by the way, the open interest has gone nowhere in this rally. Fucking no, excuse my French, nowhere. And so that trader who's genetically bearish, right? You have genetically bearish traders out there that have made money selling gold and silver for years. They're not dead yet. Those habits die hard. And those guys are going, I'm going to start nibbling on the bearish side again for whatever reason. But because they don't have a lot of money allocated, because they've lost a lot of money, they're not doing an at the money put. They're not doing a fat delta put. They're not doing a big um, they're not doing even money bets. So they're buying way out of the money puts. They're buying long shots. So what you'll see at the top is, I see it all the time. What you'll see at the top or the bottom of a move, you'd see these conspiratorial like options trade, long wing calls and short dated wing call. I'm sorry, long dated wing calls because they want to be in it for 6 months. I'm taking my profits selling gold at 4,300. I'm happy. And I go, you know what? Go out and buy me 1 year, 6,000 calls. Like, who the hell does that? The guy who wants to say to his boss, right? Simultaneously, short dated out of the money puts will get bid as well. Is that what you're seeing, Scott, or something like that?
Yeah, both. Both
Yeah.
both the tails, puts and calls getting bid.
Are
Um,
you seeing short dated puts though, right? More short dated?
I'm talking exclusively short dated. I mean,
Okay.
in equities, you've had some more longer dated action, but I wasn't looking at the longer dated in gold, to be honest. But
Yeah,
I
well
was
that's
trading the wings. I was actually trading the wings in gold. That's why I noticed it. And
yeah.
and there was just so much value coming in. And my interpretation, the put side was harder to explain, but
Right.
my interpretation on the call side is that someone just came in and said you've lost too much money, and they started, you know,
Oh, so you're looking at it that way. Yeah, yeah,
yeah,
yeah, yeah.
that
That's
and
another
yeah,
way to do it. That's another way to do it. Yeah, I mean, I could see that. I could see to your point, I could see someone who got short Thursday, Scott, in the
yeah,
rally, coming in and buying calls so he can go home over the weekend and not worry. I could see that a lot.
yeah. I mean, I was just sort of thinking about the theory that, you know, once you're hedged and your pain is gone,
Right?
then because part of this market's been driven up, presumably by short, we haven't been able to see it because we haven't had the commitment of traders.
Right. But we're
But
going to see it in a minute.
part of it's
Yeah.
been driven up by short covering. I mean, you can see because the open interest hasn't changed, right?
Yep. 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 That's right.
So,
So why don't we
to my mind, that person who had the most pain is now hedged, or his risk managers hedged him, and then
yeah,
it's
yeah.
come off. But he's the last guy, right? It's come
Yeah.
off.
But no, you're right, right, right. The losers have either closed their position and are licking their wounds, or they're hedged and are not worried anymore. Yeah, that's right.
Vince,
That's
let me
right.
add a follow up to this that's completely related to this. Just last week, Tuesday through Thursday, we had this same type of tail that, these tails that came in were both the puts, or the calls and the put volumes
Right.
skyrocketed and then completely went away by the end of the week. And so then we started getting it towards the beginning of this week
Yeah.
and heading up into the end of the week. So are we just starting to see maybe what those typical gyrations are that would be like maybe this is going to blow off into like an intermediate cycle or
But that's the other way to interpret it. Scott, listen to what I mean. I know you're listening, but the market has gotten so dynamic that the behavior that you and I see on these short dated options, or actually you saw it. I'm just working with you on that. These short dated out of the money calls and puts. Uh, in snapshot, they're a warning, right? But I think what Iggy's implying, that was Iggy, right? Implying is that we're now in a cycle that's going to have more dynamic behavior. So for me as a trader, I'd be like, wow, things are getting crazy right now. Historically, that's a sign of X. It may not be as much of a sign of X as it used to be because we're in a different environment, but I still have to look at it as a sign of X. Does that answer your question, Iggy?
Yeah, and let me just tell you what my basis was for saying that. Looking through all the other blow off tops, like in 2006,
Yeah,
2008, 2011, et cetera, you I start to see in price days where things will gap up, and I don't have data going back to those years on options or futures
right.
contracts, but
Yeah,
you start to see that gap up and then even gap down, and it starts to get very dynamic is the word you used, right, where it's
right, right, right.
it's up and down. I don't see that yet.
Gary,
And I look at the base that we just jumped off of, at the end of August, September, and that was the biggest base at the highest level that I've seen since like the 72 to 80. So
right.
my basis for that is that in the data, assuming everything now is like then, which I don't think it is, that we're probably not in a blow off top at this moment, but we could be there in a couple, days to weeks. But
Yeah, yeah.
yeah.
Well,
But
that's
in other words, yeah. So that's the basis of me.
technicians look at that all the time. They say like three gaps and you're done, or two gaps and you're done. It's like gap, like the what is it? The breakaway gap, the runaway gap, and then the island top, and then yeah. So gaps mean to actually to talk about what Scott's saying is gaps mean people are getting tapped on the shoulder and they're all covering, which could be a sign of an overextended situation, but it could continue to run off. The point is when you start seeing this gappy behavior in either direction, you tend to not be um, not be married to the trend anymore. So it's kind of like we get it's the breakaway gap, runaway gap, and then island top, and then collapse, something like that, right? So breakaway gap, you're like, oh wow, it's getting crazy, right? So you're like, I'm going to get long and I'm going to chase the trend, and that's fine as long as we don't come in below the gap, stay long. But the moment that we do get below the gap, be careful buying dips because that could be the end of it. We're near an actual market inflection point. Leon, going forward in future years, in my opinion, physical prices will be a much more important driver to precious metals than financial instruments that can be manipulated, financialized. Yes, yes. And to to if that's your intuition, I'll give you the facts that are driving that at the biggest picture as well as the normal macroeconomic picture. At the biggest picture, to bring it up again, one of the things about, I used to talk about mercantilism a lot. There's a philosophy about mercantilism that's really messed up, Leon. And the philosophy about mercantilism has to do with what you just said there. The philosophy about mercantilism, the opposite of globalism, is this. I'll start with globalism. The philosophy of globalism says the pie gets bigger. We can all get richer. So the pie gets bigger and we all grow, right? That's globalism. The sum is worth, what is it? The sum is greater than the parts. The whole is greater than the sum of the parts. That's globalism. And that's where we've been. And that's ideologically what we've been telling the rest of the world for years. Now, since COVID, the rest of the world said, I don't think that the whole is greater than the sum of the parts. And so they retrenched. Everyone retrenched. And in retrenching, you definancialize. See, I'll give you here's the cues, right? When someone says to you, the whole is greater than the sum of the parts, they're describing in financial terms leverage. The bigger picture, it's going to grow. So how could you not be involved? That's leverage, whether it's operating leverage, whether it's financial leverage, it's leverage. It's leverage of emotions. Okay. Now, the world globalizes, leverage works because everyone's global. It's like everyone's going the same way. Everyone's exhaling into the balloons. All right. And then there's an event, whether it's COVID or maybe COVID was a catalyst for something already going on in the zeitgeist. People say, wait a minute, the whole isn't greater than the sum of the parts. At least not for me, because I see the G7 getting richer and me not getting richer. And so where's mine? And so you bitch, where's mine? Where's mine? Where's mine? And then 10 years later, into this neo-Keynesian concept, you're still not getting paid. And so, as I say, you go on strike or you demand a higher negotiation, do the whole union versus labor thing, union versus manager thing. And this is, Leon, biggest picture, that's mercantilism. Mercantilism says, or the mindset behind mercantilism. This is not a compliment, okay? This is not me going, I love mercantilism. The mindset behind mercantilism says the whole is not greater than the sum of the parts. And when you stop looking at a pie that's going to get bigger, you start looking at the world as a sum zero game. And mercantilism says the world is a sum zero game. And if you look at the world as a sum zero game in trade, you just want to make sure you get yours. All right? You with me so far, Leon? Just want to make sure you're still there. Right. Okay. So when pretend the whole world goes from thinking like Obama, right? And I'm not being negative or positive. I'm saying globalization is great, to thinking like Trump. I got to take care of myself. I got to take care of my own. That's globalism to protectionism, mercantilism. But the thing about mercantilism is you've got two people that, this is where it becomes very practical, Leon. You ready? Two people meet for a business deal, coffee shop, two guys. They've known each other for 50 years. And they've been doing business with each other every day for 50 years. And they always are comfortable saying to the other guy, get me back later, right? Whether it's buying coffee or literally doing a deal. And when you say get me back later or we'll settle up at the end of the month, you're trusting. So we'll settle up at the end of the month. And it's like, we've been doing this for 5 years. Why don't we do a line of credit for a year? And basically you create these longer term futures derivatives contracts on your relationship. I trust you. We're going to create a futures contract. I'm going to do this every day for a year. Let me pay you at the end of the year. Fine. And that's a futures contract. So at that point, these two guys meeting in the coffee shop, they're developing a futures contract. They're saying, trust, the pie is, we can grow the pie together. Everything will be better. This whole is greater than the sum of the parts. I'm the parts, but together I can let my money do stuff. You can let your money do stuff. And then it reverses. For some reason, these two guys stop trusting each other. And you know what happens? They go to that same coffee shop and credit shuts down. No, no, let's do it right here, right? Let's pay right here. Let's square up. Cash and carry. I don't trust you anymore. Maybe you're sick. Maybe you're dying. Maybe you're getting a divorce. Maybe it doesn't have to be like a big ideological thing, but there's a lack of trust. And this is why it's mercantilism. When there's a lack of trust, there is no future. And if there's no future, there are no futures. If there are no futures, there are no derivatives. Everything goes from long-term big picture to spot, cash on the barrelhead. That's why it's called spot. I show up, you give me this, I give you the money on the spot. That's what it means. So, to your point, I'm going to read this thing again. Important driver for precious metals and financial instruments that can be manipulated, financialized, and regulated. Etc. Yes, yes, right? So I just gave you the big picture explaining what you feel. Now I'll give you the practical explanation of it. Here's the practical explanation. In gold, gold was called a tier 3 asset. And if you went to the window with it, the Fed window, you got 50 cents on the dollar. When they made gold a tier 1 asset, they made it, by doing that, the banks could no longer leverage their gold. One physical gold allows you to sell 2 contracts. Let's say, I'm making it up, right? Well, now it's like 1 contract for 1 bar, 1 contract for 1 bar. What do? They kill the futures by making it Basel 3, by making it tier 1 in Basel 3. And so you kill the futures, right? Let's look at it from another point of view. Same idea. You and I have been doing business for China. The Saudis in the U.S. are doing business. The Saudis sell the U.S. oil. Yeah, the Saudi and the U.S. gives the Saudis money, right? Right. We buy oil, they get money, they get the money. And what do the Saudis do? The Saudis trust us, like those 2 guys in the coffee shop, as a customer. And so what do? They buy a 30-year bond. That's a sign, right? Now, all of a sudden, the U.S. is the number 2 biggest customer. And so they say, well, China's buying stuff. I'm going to buy stuff. Biden's been kind of a jerk to us. China's got some pretty good military stuff. Maybe we could buy from them. The U.S. isn't really keeping Israel in check. They're being a little bit like too rough. You know what? I don't trust the U.S. as much anymore. So we buy oil from them, and they go, thanks for the money. I'm going to buy a 1-year bond. That's the future moving towards spot. That's the trust disintegrating. And so, because the biggest players in the world no longer look at things as a growing pie that they can all get a piece of, they are less trusting. And because they're less trusting, there's less financialization, there's less futures, there's less stuff to hide in the balance sheet. And in the end, it comes down to, what's it worth? $50 in Philadelphia. It's not like I'll give you 100, give me 50 back next week. And that's the answer, Leon. That's exactly what's going on. What you're saying there descriptively is what's going on. There's going to be, you can't bullshit futures. I mean, you can bullshit futures. You can't bullshit spot. No credit, pay me. No credit. I want money on the spot. That's it. Hope that answers your question. I haven't even looked at the other things yet. No, we're not anywhere near close to topic. Of course not. I mean, not go one, right? You don't want to get. I don't want to get even. I don't want to get arrogant in any way. I always want to keep myself honest. You said if Arizona, either way, U.S. succeeds at reshoring or not, gold goes higher. Yeah, exactly. Right. Everybody should read that. That's exactly what happened. Right. And we're going to go through what I want to go through with my charts here are similarities and differences to 1980. Not only that, but that's part of the, are we at a top? Are we at a top? Remember, they're saying the word bubble now because they don't know what else to call it because they don't understand it anymore. Excuse me. Hiccups. Right. Yes, agree. Lucro makes a compelling case for the price of $48,000. Yeah. It won't go to $48,000. It just can't happen. It just can't. If it goes to $48,000, we're going to be freaking slave labor for the Chinese. I mean, it could. I don't know. I'm laughing because I want it to happen. If it's a spot market with physical delivery, Yeah, that's right. If gold went to $48,000, the world economy would go to zero. I'm not saying it can't. I'm not saying Luke's wrong, but the point is you start at $48,000 and you say that's crazy, but it could happen. Then you start to say what makes more sense. At what point would they freak out? Yeah, we would throw in the towel. If gold went to $48,000, that would imply, without the Fed printing any more money, without any government printing any more money, that would imply that all the money that's used to grow the world was going into a safe haven, a store of value, which means we've gone from futures, there's a pie, and it's going to get bigger, to mercantilism, which is there is no pie, it's a sum zero game, right? To there is no pie, there is no sum zero game. There's like go to your room and read a book. It's collapse of complexity stuff. It's tainter stuff. Spot market going forward as problems multiply, governments will become more intrusive with regulation. Yes, Leon, that's authoritarianism. Yeah, yeah. In fact, you're talking about that in a. Let me just read this out loud here. Governments will become more intrusive with regulation, manipulation, financial controls, which is why physical spot is needed. Yeah, I wouldn't look at it as the correlation between intrusiveness means spot is needed. I would look at it as the government will get more intrusive because you can't control spot as much as you can control futures, right? Because spot's the real thing. What is this worth? It is what it is. It is. Here's like a little anecdote for you. Did you ever see the movie? Many people here probably saw the movie Deer Hunter. And there's a scene. There's a lot of great scenes in the movie, obviously, but there's a scene in the movie Deer Hunter where John not Cassavetes, what's his name? Italian actor. He's in The Godfather too. Godfather as well. Casal, John Voight. No, not John Voight. No. One of the other, the little guy who wanted to borrow the boots. That guy. The guy who played Fredo. That guy. All right. So anyway, the guy who played Fredo in The Deer Hunter, yeah, Voight's character was great too. Um, he has He has many confrontations, but he has a confrontation with De Niro, and De Niro's. It's about the gun thing, and he's waving a revolver around, and De Niro says he grabs the gun from him, and I forget where the scene is, like what the scenario is, but he says, he holds I think he holds a bullet up to him, or he holds the gun up to him. He says, John Cazale, thank you. He holds the gun up to him, and he says, do you know what this is? This is this. And it's a great line because over the years it's changed the meaning to me because what he's saying is this is a bullet or this is a gun. This is what it is. You can't pretend it's something else. You can pretend the future is something else. You can't pretend spot is something else. And so governments, which had been in a neo-Keynesian world, comfortable manipulating behind the scenes the invisible hand. Oh, we'll cap the futures. We'll raise margin requirements. When you're dealing with spot, you're dealing with this is this, and the government can no longer soft shoe its influence. It can't, let's shut them up because spot is spot. It's this, and so as part of the authoritarian concept, it becomes when you start worrying about when you start to stop looking at the futures price as the price of gold and you start looking at the price of gold at spot, you're looking at physical availability. And when you start looking at physical availability, the US, using US as an example, a country that is worried about getting available assets will start to, you can't manipulate spot price because it's real. It's not, oh, interest rates are doing this. No. It is what it is. That's why I say it is what it is. So that's what this means, right? It is what it is. And so what does a government do that can't manipulate the financial aspect? Well, let's have the SEC change requirements. Let's do this. What does it do? It restricts information flow. It says, okay, that spot doesn't matter. And then it says, and then down the road it says, well, they're manipulating spot. That's not the real fair price. And then down the road further, they say, well, we're going to ration it. You can't buy it anymore. And then down the road, they're going to say, you can't sell it anymore except to us. So like that's the evolution or de-evolution of a global market. It goes globalization where they can massage the markets financially. Oh, we've got the balance sheet. We'll take the losing trade and put it over here. It'll be like, what was an example of that? Yeah, when a company's not making money, they used to frequently create a bad, like a bank isn't making money, they create something called a bad bank. And so they take all the bad loans and they put them in another company. And they'd say, that's the bad bank. Let's sweep it under the rug. There is no bad bank when it comes to gold. You either have the gold or you don't. You can't put it on another balance sheet. You either need it or you don't need it. He had it coming. Yeah. Wait, what's that from? He had it coming. Is that De Niro's line when he's talking about the boots thing?
No, he gave up Sonny. He deserved to get killed.
Oh, you're talking about. Oh, yeah, you're talking about in the. Well, okay, well, it's very, very intolerant Italian of you, Steve. I don't know about you.
Boy.
I promise I will not. Nothing will happen to him while my mother's alive. My mother's dead. Go take him fishing. I mean, come on, that's crazy. That's crazy shit.
The bells are ringing.
Yeah.
Mama.
Yeah, Cazal died really young, really young. Everybody loved him too. He always seemed to play a softie, but my understanding is he was just tremendously talented in many ways. What Trump said that, yeah, she had it coming. Yeah, Leon, that's it. All right. So, all right, let me, I may have missed a question or two, but let me get back to this chart. So here we have our 5 days, right? We're going to do our commitment to traders here. Day one, let's, yeah, it's 251, so I'll move quickly. So we got 5 days. We've got up, down, up, up, and then the last 3 days, right? So the first day is up. Open interest goes up by 4,900. Yeah. Can I use yellow over here? No, that sucks. What's a good color I can use over there? Probably. Yeah, I can use blue. All right. So first day is up 4,900 contracts. Next day is down 6,800 contracts. So these 2 days are normal, right? Next day, 3,000 contracts, 2,900 on an up day. Okay, so that's a little bit of short covering. In fact, it's not perfect looking, but that's like your little fishhook concept, right? The market comes in, doesn't make a new low, so it's not pure, comes back up and goes green, but it's still inside this candle. You should buy it above the red here, in hindsight. All right, so that's like these really short-term day trading things are getting really good now because they happen fast, and you're either right or you're wrong, and you move on, but they happen right away. So on this third day, 2,900 contracts are closed in an up day. That's short covering. Bullion banks. That's my opinion. The next day, 4,600 contracts, by the way, in an up day, but this is more than 4,600 contracts buying. This is probably like 10 to 15,000 contracts buying. And the first half of the day is shorts covering, and the second half of the day is longs getting in. Fifth day, up day, relatively speaking, a small range. Those aren't long wicks. That's just random lines that I have there. 2,300 contracts get out. So that's an up day with some shorts covering and longs getting out. So that's another bullion bank coverage, in my opinion, right? Then we got the last 3 days. Up 2,700 on an up day. Down 1,900 on an up day. That's crazy. So now I'll tell you a story that I'm completely making up, but it fits. It checks all my boxes. That's a $100 rally on a short covering. That's a $100 rally on a short covering rally day.
Hey Vince, sorry
Yeah?
to interrupt. That's consistent with tail buying on the calls.
I wasn't up to you yet, dude.
Sorry, bud.
No, I'm messing around with you. But that's exactly it. No, that's like the last part I was going to say. So you have a day where the market rallies over $100. Open interest comes in. So I want to spell this out a little bit because this is an important day. On this day, you had two types of buyers. You had longs getting in, funds buying, it's a new high, let's buy it, right? And you had shorts covering. If it was just longs getting in, open interest would have exploded because new longs getting in, new shorts. But there was no one left to short it because the bullion banks were covering. Shorts getting out. And who are the bullion banks covering from? Because they're the only ones who sell it at these levels. The bullion banks are covering from macro discretionary selling it again. So, I mean, like Scott, I'm like 99% sure now. So on a day like this, where the market gets ahead of itself, and you sense that the bullion banks understand that the bullion banks are the biggest banks in the world. Let's just say J.P. Morgan, whoever it is, right? And they they're needed to be protected, and they're protected by the BIS, which is essentially all the central banks. Bullion banks are the executing arm for the central banks. So when a market gets out of control, the BIS comes in and puts a lid on it. How do I know that? Because when a
Yeah,
market gets
I'm going to
what?
disagree with you on that
No,
again.
but it's not just the BIS. I'm just hear me out.
Okay.
I'm explaining a concept. I'm explaining a concept, right? When a market gets out of control, when a market gets out of control, um, somebody who's the backstop of the whole market, the backstop of the whole market, the person who says, I need to keep it orderly, that would be the exchange. We're going to raise margin requirements. An exchange that says we're going to suspend trading for a couple hours. They do like lock limit type of thing. Uh, there's all kinds of things. And the reason you do that legitimately is to make the market take a breath. And the reason you do that conspiratorially is because the people that are losing money are your friends. All right. So now, historically, the backstop to markets, specifically the gold market, has been the bullion banks. When it rallies, they sell it. When it drops, they buy it. They're the ones who keep it in the range. Now, of course, they like it to go lower than higher, but the point is they have the money to keep it as a backstop. The bullion banks are damaged. They're not the backstop anymore. Somebody backstops them. It's kind of like too big to fail. And the backstop for them has been the Bank of International Settlements. Is it always the Bank of International Settlements? No, no. Could it be a fund selling? Yeah, it could be the macro discretionary guys seeing that the banks are covering and they're crying uncle, which gets to the whole thing of like it's almost like a collaboration. Anyway, so this is going to sound paranoid, but there comes it happened last time. There comes a point where the bullion banks start to cover and the macro funds say, "Wow, they're covering. We should probably sell into it because if they're covering, that's our opportunity to get some volume and get liquidated." Anyway,
Hey Vince, this is Iggy real quick. Just on that day,
uh-huh.
tell me this. Why why are the calls screaming higher just as much as the puts? Because if what you're describing, again, a little person like me who hasn't worked on these desks would presume that the calls would start dropping because they see these, these big people sitting on the price and putting in all these, tail puts. So I'm a little confused as to why those shoot up as well.
Well, I mean, there's okay. I'll answer that question. I mean, I answered it partially, but I'll spell it out. There are again, it's physics, right? There are conflicting forces, and as the market's making new highs, one force is saying buy it because you're short, you idiot. Meaning the futures, right? Buy it because you're short, you idiot. Get out. That's the tap on the shoulder that Scott's alluding to. The selling force is the macro discretionary fund that's taking profits. And as they're selling it, they're buying calls to keep exposure, which I described, right? There's also the guy who's short as the market's making new highs. He's like, I don't want to buy it. I'll just buy calls and he stopped out. So now you have, even though you have buyers and sellers of futures, you have buyers and buyers of calls. Shorts are buying calls because they're not covering their futures. Longs are selling their futures and buying calls. You have what's called, and that's what the skew is in the market. That's what the not the kurtosis, but the stochastic process. All right, the stochastic process that is involved in markets at the options level happens here. At the you have natural buyers of calls. I'm a speculator. I think it's going up. I buy calls. Then you have panic buyers of calls. I'm short futures. I need to buy calls or I'm going to get fired. And then you have macro discretionary that's selling futures and buying calls. So you've got three natural buyers of calls. Number one. And number two, and this is key. This is key, Iggy. Number two, I just gave you the behavioral pattern. Number two, there are no natural longs of those calls. Those are brand new strikes with no open interest. At least when you have open interest, you have people who care. Now you've got a whole new, like, hey, let's talk about the 10,000 call. Someone make me a market in that. No way. I don't know what it is. Like, what the hell does that mean? So you're in uncharted territory and people start to lose their tether. Does that answer your question?
It does, but let me just slightly alter the question, which is or pivot on it, which is that would you also expect people who are doing these butterfly or collared calls to be a high percentage of those numbers, and that's also why it's going up, or was that
No.
even included in what you were
No,
just?
no. Okay, well, there is an example for, okay, butterflies. No, nobody's doing butterflies right now. People are running for their lives. Like we're doing butterflies because we're not crazy. Like we're not freaking out right now. There are people that have done covered calls, right? Let's say your typical equity GLD guy. I'm long GLD and I'm short calls and I'm short the 4,500 call, right? And then I get a margin call on the 4,500 call and I say, oh, screw it. I'll buy that call back and I'll sell my GLD out. Or screw it, I'll buy the call back and I'll sell a 5,000 call. So you do have that, but that's not what's going on. That happens, but that's not enough to make a dent in what's going on right now. Okay?
That's what I figured. Thank you.
Yeah. That's that you usually see that. I mean, the thing is that behavior, I'm long GLD, sell a call, the covered call writing concept, that's a well-worn strategy in equities, and it has its long-term time frames where it comes into gold. But right now, there's really not a lot out there. There's not a lot of that shit out there. Like people are freaking out on calls right now. And by the way, the next time you see gold rally, how about this? The next time you see gold rally and volatility come in on the call side, that's covered call writing. In addition, dominating other behaviors. All right, so hold on. I want to get to Scott's challenge in a second. Um, technical is more irrelevant, in my opinion. Trading pressure technical is more relevant and more of a mugs game as flows and news. Yeah, exactly. Or Leon, how about it this way? Leon's basically saying that as the market gets a deeper and busier, technicals will become more irrelevant because flows are more important, and that's true. You know, like people look at people that look at fundamentals, they're looking at a reason for the market to move. People that look at technicals look for a footprint of the fundamentals. Technicals are a footprint of the fundamentals. You know, well, I don't care about the fundamentals, but I know when it gets above here, that this is a danger and it could go higher. And then, sure enough, 3 days later, it gets above there, and then 5 days later, you hear a news story that fundamentally something is wrong. Okay, the footprint or the fingerprint of technicals. So you got fundamentals, technicals is the flows. So if you're on the desk and you're seeing why it's going above that price, you're saying, well, that's the fundamentals asserting themselves and the technicals are manifesting. But if you're on the desk and you see the person buying it and that person is, Soros or Tudor Jones, you're like, okay, the fundamentals, the technicals, and who's buying it? It's not Vince. It's Paul Tudor Jones. So you're like, okay, buy it. So the flows create the technicals, Leon, to the extent that we can see the flows. That's exactly right. Yeah, exactly. Right, exactly. That's all part of the physical part of it, right? So technicals matter less, futures matter less, futures charts matter less, spot matters more. I mean, yeah, that's all crazy stuff. Does change in IV not affect price in this situation? Price in the option or price in the future, Matt?
In the option.
Yeah, if you change it, when you change implied volatility, it makes the price of the option go up. If IV goes up, the price of the option goes up. What are you getting at specifically, though? What's your next question?
No, there was another. I had another situation where an option was up 5% and then the underlying was down 5%, and
Yeah.
I couldn't figure it out, but I tracked it back to that. It was just a change in IV.
Yeah, right. Change in IV, exactly. So, I'll give you a real life example that doesn't happen too often, but it happens. When a market's making new highs, on occasion, what you'll see is the market will make new highs, and then the exchange is going to raise margins, which is bearish. But as they're raising margins, and by the way, Scott, this is the whole option thing. As they raise margins, the market starts to come off, and when the market comes off, options volatility should decrease, but calls would stay bid as it was coming off, and that's because people were buying calls as they were selling their futures. So you have moments like that. It doesn't last long, but it happens. Scott, so what did I get wrong, Scott, or what might I have gotten wrong?
You're trying to accuse the BIS of slamming this
I am
market again.
But you can't prove me wrong, so I'm right.
Well, I'm gonna use your own theory against you. But
Yeah,
I think this is natural market forces. I
you
think the
do.
BIS, and if you look at the Basel III rules and your theories about mercantilism, et cetera, I think the BIS is part of bringing gold back into the financial system, into the heart of the financial system.
Okay, but we're not at odds on that. The other stuff I'm not going to disagree with, right? I mean, we're going to have fun with
So,
that,
so,
right?
so
But
why are they slamming? I mean, this is the same as when Macro D sold before, right?
no, it is. It is.
Why
Hold on,
why
hold on.
would banks cover into their daddy saying, "I've got your back and I'm going to slam it"?
Right. No, I why would banks cover? Okay, I understand. Like, how we have a different interpretation of how it's flowing, but we see the same things. So I'm going to say what I'm saying before I forget my lie. Right. Um, First of all, your point about the BIS is about money. Why would the BIS give a shit about gold going up? Like the point is, I'm simplifying what you said, but the point is,
Vince,
BIS
Vince,
is yeah,
undisputably, every other time it was the BIS. Going back decades, I agree with you. The
yeah,
last
yeah,
two times, I'm not convinced.
right,
That's all.
right, okay, yeah, oh, right, exactly, exactly. But yes, I understand, that, but I do know. I do know that even though the BIS, right, all they care about is the money itself. They don't. All they want to do is make money, which you'd expect. Even though the BIS um, uh, has already embraced the new monetary order. You with me on that, Scott?
Yeah, well, I think they're part of ushering it in.
Right, right, exactly, exactly.
Yeah.
I'm saying to you, they still have a responsibility to the market to protect their satellites. Okay? So, for example, I'm not trying to impose this, but I know that there's still, they are the backstop. And when I say that they're putting a lid on it, I don't mean they want it to go down. I mean they just wanted to catch a breath. So my logic is sound, even if you don't agree with me. Why would the bullion banks cover if they knew the BIS was going to sell? They didn't know the BIS would sell. They panicked, I believe. And at some point, someone said, dude, someone called up and said, I just panicked. Can I get a day to keep a lid on this so I can get some of my shorts back? There's no one selling. And the BIS said, sure, I'll do it. That's my story, right?
Yes,
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 yes, yes,
yes,
yes.
yes, yes.
Who owns the
Who owns
BI?
the BI?
Who owns
Who
the
owns the
BIS?
Wait,
BIS?
wait,
The
wait,
The
wait,
B.
wait.
B.
Wait, whoever's saying that, you're echoing. You're like there's a big echo in there. All right. But
Oh,
hold on,
Hang
hang on.
on.
let me finish
Is that
losing my
better? Is that
argument with
better?
Scott
Okay, I'm just saying.
before
I'm
you
just saying.
back me up.
Who owns the BIS? The
Yeah, exactly.
banks. The banks. The
Right, but
banks are
before
asking.
right, but before you make me right, let me defend myself to Scott because
Yes.
he's probably more right than I'm giving him credit for. No, so as a banker, as a consortium of central banks, the BIS doesn't want JP Morgan to go bankrupt. The BIS doesn't want them to go bankrupt. They want them to survive because the BIS is the banks in that sense. So I'm just saying we're having a battle of narratives here, right? Neither one of us can be proven right or wrong. I believe that the BIS is very reticent to do anything now. All right, Scott? I'm with you on that. I believe the
Yeah.
BIS couldn't give a shit because they now are trying to develop a relationship with the new money. And the new money is China and gold and whatever it is, Enbridge or Agora, or how gold's going to be a repo product, all those things that I say that I believe are going to happen. But at the same time, they have
They're
their
playing. They're,
employees.
they're playing both sides, Vince. I agree with you.
Right,
They're
right.
playing both sides, and they're
So
in bed with everyone.
they're a bit with raising their banks. That's what they do.
They're in
So
bed with
I mean,
everyone.
here's an example for you. Here's an example for you. I mean, not an example, but just so these guys can hear this concept that you're talking about a little bit more. I believe, cannot prove, but I've seen it before because I've done it before. J.P. Morgan got their asses handed to them in 2024 by the Chinese macro funds. And I believe JP Morgan said, I don't care. That's the price of entry because now they're my customer. Now I've won them over and now they're my friends. And now I'm going to just run everyone else in. So that was like a price of admission. So I look at the BIS and I say, well, the BIS is kind of like, what's the word you said? Um, playing both sides or whatever, have their whatever, playing both sides right now. Yeah, now the BIS is truly a market maker. I mean, think about this, Scott. The BIS, I mean, this is what I pray, right? The BIS will sell it um, for an hour to keep a lid on it to make sure JP Morgan. So it looks like at least they're doing their job for JP Morgan. But this is where the other side comes in. The BIS also knows that China is buying, let's say, at 4,100. Maybe the Chinese insurance companies are buying there. And the BIS knows that because they see that order flow. And the BIS buys or tells the bullion banks to buy too. Like, it's crazy, but the BIS they should be making money hand over fist. So I don't disagree with you. I think the difference between you and I on this is in the, what's the word I'm looking for? Is in the size of the BIS involvement. For example,
Yeah.
and this is where,
But Vince,
yeah,
I'm not going to disagree with you, but
yeah,
at
yeah.
all. But I'm just saying you can explain this. You can explain using your own methodology, which is excellent. You can
Thank you.
explain this with bank short covering,
Oh,
and then
yeah.
you can explain and macro discretionary something. We don't have the data for that, but we have to
Right.
assume they're looking for exit liquidity.
Absolutely.
Okay, and
Right,
it's
right,
season using your own methodology.
right.
And then Friday looks like fresh shorts have come in, which are your specialized, the guys who get good at it when they come in early.
No,
And
hold on the front. Okay, hold off on the fresh shorts. Okay,
okay,
hold off on that.
okay,
I'm going to tell you that because every Friday's been bad. All right, so
yeah,
we're going to get to
yeah,
that. But you follow me? So I like your case, your logic doesn't work as well if that 3,500, this thing here, becomes minus 20 grand. You follow?
no, it doesn't.
Okay. All right. You're saying on Friday new shorts came in. That's what I'm showing
Yeah,
here.
if that's minus 20 grand, yeah, then it's a different
You
story.
follow me? Okay. But I'm
Yeah,
not saying it's not. I'm not saying it's definitely minus 20 grand. But just for everyone else, because this is the market dynamics of how these things operate. So one of the things that I will say, and anyone who trades will say, when you have a big position. Let's say I have a position that's too big for the market. Let's say I have a market position that's 20% of the open interest. That's a crazy number, but let's pretend that I do, right? And I have a big picture theory, and I know who my short is. I'm the long, and my short is Scott. Okay, and we're the two biggest people on the market. Like it's Ali and Tyson, right? When we're going head to head with each other, everyone else is playing, but they don't matter, right? So for some reason, I'm short and I'm bearish and Scott's long. And the market makes this crazy new high. And I get tapped on the shoulder, or maybe I just tap my own shoulder and say, oh shit, I've got to cover. This happens in the market all the time. The biggest short is covering. Anybody who's on the long side of that trade says, I want to know when he covers because that's my exit liquidity because I can't sell 20% of my longs to all these fucking five lot guys. I need Ali to cover so Tyson can get out. And so when they start to cover, there is no doubt in my mind that the macro discretionary guys are going, wow, we need to do some of that because who the hell knows what's going to happen after they cover? It could go up more, but I'm not, you need to, there's no bigger fools to buy. Put it this way. The open interest objectively is not going up as we rally. So whether it's because of macro, it's not going up. That means there's not a lot of fresh money coming in. So when the banks cover shorts, you've got to participate. The rule is you must participate when your biggest counterparty is covering. That's just a fact. You have to do that because that's the rule of liquidity. That's what Scott is saying. And so what I'm saying on one extreme, just keeping them completely separate, what I'm saying is this market was capped because the BIS is keeping a lid on it, which is very possibly true. And not capped like they used to cap it for 6 months, cap it for a day and have the market just collapse under its own weight. It's cap it for a pause. It's raising margin requirements for 5 minutes. That's one side of the story. The other side of the story, which is also borne out by the data that we had, April through July, is that what it was? Or was it like I don't know what it was, but we had like a 4 month time. Wait, I think I have that chart. Hold on, hold on. We had a four.
It's April till the end of August in general for the
See
price
this
chart.
here? Right. So see this here. This is open interest coming down with the market going up. That's bullion banks covering. And during that time frame, Scott and I had our first conversation about this top topic. And the conversation went something like this. Oh, look at that. The BIS hammered it again. And but then the market's rallying. I'm like, well, the BIS is that's wrong. The answer is Scott's right. The BIS may have sold it here, but they're not. But the banks were buying afterwards. So the point is, the banks were covering shorts. The BIS was not bailing them out. Maybe they did for 5 minutes, but the BIS was like, you guys have got to take care of your own freaking problems now. And the macro discretionary was selling it. To Scott's point, if the biggest short is covering, then the biggest long has to take some profits. My point, more conspiratorial, and I know is true. I just know it's true because I've been in these conversations. At some point, there was a liquidation only moment, and during that liquidation only, the big macro discretionary funds were told, "Listen, the bullion banks are covering. Don't front run them." And as a person who ran a macro fund, when the government when the word gets out on that, you say, okay, I at least want to look like I know what I at least want to look like I'm playing well in the sandbox. And so during this whole time frame, this was macro discretionary selling to bullion banks as it rallied. They took profits. The bullion banks were initiating. This was a short covering rally where the bullion banks got their asses handed to them. And now this rectangle that I have here is a short covering rally with the bullion banks getting their asses handed to them. Okay, so coming back to what Scott said, if this is not BIS capping, if this is macro discretionary taking profits, and this is happening, the question is, Scott, this is a genuine question. What the hell forced the bullion banks to cover on this day? Right? Maybe they didn't. Maybe it's someone else. I don't know. You
Or
follow?
losses, losses.
Yeah, but I mean, right. I mean, maybe there's some real, maybe there's a couple
Because they
really
got the
big,
limits back. Remember, they got the limits back around about year end.
they,
And they're
right,
just
so you're saying they're being more disciplined about their loss covering?
no, I
Like,
think
like,
that looked like someone was forced to cover.
yeah,
Just the price action, what
it
was
totally
happening
did.
involved.
Right.
I think risk
So,
managers got involved. That would be my guess. I
right.
have
So
no
when you
idea.
say risk managers, you're actually talking about risk managers on the bank desk, not a fund desk.
Yeah. Bank desks.
Oh,
Yeah.
see, I was, you weren't, okay. I wasn't
No,
sure. I was
not
like,
risk managers as in the skillful trade. The risk management department came in and
yeah,
said,
No,
and
that's why,
they've got the power if it's an option book to buy the tails or whatever they
yeah.
need to do.
No, but
But
that's why I brought up the macro discretionary selling calls or buying calls, because when you said risk manager saying take profits, I went with the taking profits part. Okay, one thing Scott said that I completely agree with is that a bank or banks in this rectangle here cried uncle again. Did they cry uncle because they're going under? No. They cried uncle because since this disaster that happened here, all the banks are allowed to trade again, but they're not allowed to have more than X risk. And so they covered. So I guess what I'm getting into here is that whether I'm right or wrong doesn't matter. This is where you get technical, right? Technical analysis. Whether I'm right or wrong doesn't matter. The market was capped. It's a bearish engulfing candle, and open interest has been dropping. And in this last part of the rally, open interest did not go up. So you must think that this market should be toppy. And then I can give you all my stories. That's the BIS selling right above on that wick. We get to that wick again. Maybe I'm wrong. Maybe I'm right. It doesn't matter. The point is, somebody covered, and now the market's being sat on. Could there be another bank? Could it be serial coverage? Yes. Serial coverage, up $100, bank covers. Another bank goes, oh shit, bank covers, right? So, but we're not getting that. We got up $100, bank covers, and then down $100. So somebody sold. In fact, here's a story that makes you right, Scott. But let's say there's 5 banks that are too short. Four of them cover in here, and one of them covers at the last minute because he can't take it anymore. You know what I mean? Someone's got a bad risk manager. That's what I'm getting at. That trader's dead. Anyway, is
Vince,
Basel
I
three
got a
dead?
quick question for you that might help, and it may not help, but settle this. Does the fact that it happened at like say, 8 or 9 p.m. or 10 p.m. On Thursday evening, New York time, make a difference as to who's likely the perpetrator?
Uh, yeah. Well, are you telling me this happened at 8 or 9 p.m. Thursday?
This started getting capped while I was at the theater on Thursday evening.
Oh, Cap. I thought you meant the rally. Yeah, I was gonna say that doesn't make sense. 8 or 9 p.m. Yeah, I mean, it makes it easier to identify who one of the big sellers was. If it happened at 8 or 9 p.m., it could have been China. It could have been China's macro funds taking profits, which makes Scott closer to being right. I mean, it makes sense. China bought it. They ran in the banks before. China's buying it again, and now they're taking profits. Absolutely. And I would say to you, because China is definitely making silver available to help London out, that China is without a doubt playing by the rules. They do not want to be viewed as a currency manipulator. They've gone out of their way over the years to defend themselves, and they do not. Look, China wants to sit back and say, in my opinion, China wants to sit back and say, we didn't do it. You did it to yourselves. That's what they want to say. And they've done that in the past before. And they made their silver available for London. So there's probably a good chance that they also were selling gold that night. Yeah, I believe that. All right.
Hey, Vince, one thing when you have a second.
Oh, yeah, yeah.
Um,
Is
you
that
asked me
Nigel?
yes, it is. You asked me to
Hey.
put my questions in the chat, and I put them in a while ago.
Yeah, so ask me now, please. I've been really bad at this.
No, that's all right.
Okay.
It's all right. Yeah, no, and I agree with everything you said about the BIS.
Yeah,
I
yeah,
think
yeah. I'm with you,
makes
Nigel.
good.
We can't let Scott be right on this, okay?
So I
Even
had.
though he probably is right. This won't be the first time that he's been right. Anyway,
It's funny.
what do you want to ask?
Okay, so I had some questions yesterday about Hartnett and the BOA, because really what they were saying made no sense. It was
Hartnett?
yeah,
Yeah.
made no
Yeah.
sense. I mean, first of all, they're saying the gold is both underinvested
Yeah.
at 0.5% AUM and overbought. That does
Yeah.
not make sense.
Okay, let me answer that question very easily.
Hmm?
That's an analyst. All the bigger analysts are saying that to cover their asses. They're saying, I think it's going up. I'm telling my people to buy it going up. I'm telling my big funds to buy it, but it's overbought. That's just an analyst covering his ass. It's under owned but overbought. I know that. I've seen it before.
Yeah,
It's
and
the
we've
same
talked
thing
about
as when you and I
yeah.
say,
Yeah, we
it's the
talked
same
about
thing
it
as when
before.
you and I say, I'm bullish, but it looks a little toppy right now.
Yeah. No, and we talked about that before.
Yeah. Yeah.
And the other piece of that, which also made no sense, was that there's so many tailwinds for gold that Hartnett is saying, hold, don't buy, even though there's even more tailwinds over the weekend. I mean, long rates are coming down. Besant is going to come roaring in QE to buy long bonds. So why shouldn't I buy? Okay, and I did buy some end of day Friday, by the way. And then the Founders Kiss, post today, which I thought was very good.
Wait. What kiss? Whose kiss?
Founders Kiss. The Founders Kiss. Your post this morning. About
Oh,
Jocelyn.
yeah. That was my title. Yeah, I made up the title. Basically, that, by the way, hold on. Let me pause this for a second. So what's your question?
So I thought the post was very good, regardless of the title. Very, very good indeed. The one bit that floored me was Joshi recommending shorting silver right now in this supply squeeze. That felt like a kamikaze suicide death wish.
Yeah. That's BCA. For those of you not familiar, BCA is a British firm. They specialize in fractals. That's their niche. And they've been really good with Bitcoin, and they've been mediocre with gold. But their analysis on the equity markets and bond markets is also very good. They're not afraid to have opinions, and they're not afraid to state them. Now, with regards to this opinion, BCA is saying in that KISS post, it's saying, um, it's saying, well, the main picture is it's saying gold and stocks are going up because inflation is going to become untethered, because yada yada yada, QE, YCC, all stories that we talk about, but they're legitimate. But they said, but here's why I see the logic of it, even though they didn't say it this way. Why would they say sell silver forgetting the fact that they're not physical guys. You follow me, Nigel? They don't care about the
Right.
physical aspect of it, whereas we do.
Right.
So let's pretend they're only looking at it as a neo-Keynesian financial tool. And what they're seeing is, I'm taking their side on this. What they're seeing is, well, gold's overbought, stocks are overbought. Um, Gold should come in, but stocks could come in. I don't know. Well, let's sell silver because it's not gold and it's industrial and it's equity based. So if equities drop, silver won't do as well. If gold drops, silver will drop more. I mean, that's my only
I got it. I
reason.
got it. So they're saying silver has to drop because of
Yeah.
technicals. Meanwhile, there's a friggin' fundamental
They
and
don't look at,
momentum
they
tsunami.
they don't look at fundamentals
I know.
at all.
I know.
Yeah,
I know.
BC doesn't do that.
Yeah.
They'll look at fundamentals when it fits their story, like with Bitcoin. There's limited Bitcoin. They have good stories, but they're not a fundamental firm. They're very, very like some people are technicals. I don't care about the fundamentals. Those guys are fractals. I don't care about the fundamentals. Yeah, absolutely, absolutely.
Okay.
And that's why I mean, like they put a trade on here. Give me an idea, like an example of that. They had a trade on about a year and a half ago that I wrote about, and the trade was well, first of all, they had a big thing. Bitcoin's better than gold for these reasons, and they laid out their case. And I think I wrote on it saying their case didn't make sense, but I felt like doing that, but it didn't make sense, even though I liked Bitcoin. And then they said we're going to buy Bitcoin and sell gold, and halfway through the trade, they said we're covering our gold. This doesn't make sense.
Yeah.
And they stayed long Bitcoin. I went, okay, those guys are risk managers. They're like, this doesn't make sense. Or I did. So I think what we'll find out is if silver rallies, they will say, we covered our silver. It doesn't make sense. And that's
Yeah.
it. They're financial guys completely.
Yeah. I mean, I do agree that they've diverged, and we've talked about this a lot, that Bitcoin is now exclusively risk on, and precious has gone to being flight to safety, and they should be diverging.
They should. I mean, does anybody want to disagree with that? At least right now, that's where they are. All right. So, Jake, is Basel III dead? No, Basel III might be technically on hold because of the again, regulatory wise, where no one's talking to anyone anymore. So Basel III may be delayed, but it doesn't matter. It doesn't matter if they do Basel III or if we do that Basel III. China's doing Basel III. You know what I mean? It's a monetary store value. Basel III is not dead. But that doesn't have an effect on our market. That's old news now. That's old news. Like that's in the market. That's already been discounted. What's coming up and is not dead will be beyond Basel III. There's HQLA. Those of you not familiar with it, Basel III. I've said it before, but I'll say it again quickly. Basel III is gold is recognized as a legitimate store of value. So it's tier one. So for every $100 of gold you have, you get $100 on your balance sheet. And that allows a bank that has gold on its balance sheet to say, I have this $100. It offsets my losses. But you can't do anything with it. It's locked. HQLA says, not only is it a piggy bank on my balance sheet, but I can borrow against it. You can't borrow against your gold on your balance sheet as a central bank yet, or as a government. I'm not sure how it works. But if it becomes HQLA, which is high quality liquid asset, which is a matter of legal, not justification, legal, whatever, legalese. It's a matter of rules. If that ruling changes, then the gold goes from Basel III, which is why we had this rally. A big part of Basel III, a big part of the rally is deleveraging, definancialization, deglobalization as manifest in the policies of Basel III. But the next level is, okay, so now gold is a real asset. What are we going to do with it? Technically, it's still a pet rock. It's a pet rock that we can use to offset our losses, but we're not using it for anything. And the next thing is China's going to be like, listen, that pet rock on your balance sheet, look, over in the West, they need the gold to stay on their balance sheet to offset their paper losses because they're still in a paper world. We have the gold and no debt, or maybe they don't have no debt, but you get my point. We have the gold. Let's borrow against it to grow the economy. So that's where you get it. Did you say you had some? No, I don't have a version of it at all. No, I have Randy's charts and my process. No, nothing was released. Anyone follow it? Anyone here follow? Yeah, ideas for SLB calls. Britt, what do you, are you, did Michael make suggestions for calls or options? Or are you looking for suggestions? Oh yeah, yeah. No, he doesn't give out suggestions or ideas. First of all, if you're asking that, he doesn't. He buys leaps for himself. I think that's what he does. Um, I will send all of you his work tonight. By the way, we have been recommending him to people, and I did those posts I do. They're legitimate posts, but they're also very positive for him because I feel that way. And he's returned the favor by in his most recent report, he put Goldfix in there, and he basically said, he's a pure technician. He doesn't care about fundamentals. You know what I mean? He's just technician. But he put something very nice in his report. And he said, for news and fundamental analysis, we think Goldfix is the best out there, and we used him. So that's really nice. So anyway, I say that because I
Vince, can I
want.
say something?
Yeah, sure.
So I subscribe to MSA and obviously yourself as well, and I wholeheartedly agree that the combination of the two
It's
is
a
really
great
good.
film. It's a
It
great
is,
film.
it is, and I really value Michael Oliver's work purely for
Yeah,
the long term investment side of things.
yeah,
So his sort of perspective on the fundamentals of various markets, and I only subscribe to the gold and silver
right.
markets. But yeah, no, just to agree on that point.
Okay, so you agree? I thought yes, yeah, yeah. Thank you. Yeah, I mean, look, if I'm not, look, I don't get a commission on Michael's sales. Okay, let's just say I don't do that. Like, that's not my thing. I just say if you Michael as a technician, by the way, there are two types of technicians that I will pay attention to if they're any good. One is the long-term technician who's honest. And Michael is a long-term technician who's honest, meaning he's top down. I look at secular, fundamental, and then I wait for a trigger technically, right? He looks at long-term technicals. That's his fundamentals. And when the long-term technicals are lined up, he then looks for short-term technicals to get in. So it's kind of like he's using shorter term technicals to trigger longer term effects. And I use secular, my stuff is working for the last 4 years. But believe me, for 10 years before that, nobody cared about that shit. Like, it's basically I got lucky, right? But so the idea is we're both fundamental analysts in the sense that I look at the fundamentals of the people and the markets and the market structure and the philosophy, and then I look for a technician or my own system, the VBS volatility system, to get into a trade. I want to have the wind at my back type of thing. He is a fundamental analyst. He looks at the fundamental technicals, and then he comes up with his shorter term stuff. That's how I look at it. And then for my shorter term stuff, I'll use my VBS, or I use Polytrends now. It's pretty good, but I haven't been focusing too much on that lately. But yeah, that's that. Who said that, by the way? I didn't see your name.
Sorry, I had to unmute myself. It's Julian.
Oh, hey, Julian. Hi. Yeah, thank you for saying that. And I agree with what Julian's saying. Um, uh, if you want to I love, just speaking as a person who does anything, I love a multidisciplinary approach to making a decision. Simply put, I want different ways of looking at it to corroborate or contradict my way of looking at it. So that's why Scott and I are going to have these conversations. These are great conversations to have. It's like, there's an expression, I'm not sure what it is. Maybe it's ergotics, maybe it's consilience, but it's kind of like if you're a carpenter, they say measure something 3 times before you cut. Cut once, measure twice. Yeah. So the carpenter uses a tape measure, and he measures 6 inches, 6 inches, right? He's measured it twice. And then he cuts, but he's wrong. And he's wrong because his tape measure is wrong. His methodology is wrong. So what I would do as a carpenter, a trader, is 6 inches, 6 inches. Hey, John, come over here and measure this. I want to make sure I'm right. That's being careful. So John, his tape measures made by a different company. So for me, it's like 6 inches, 6 inches. Then I'll measure the other side. I literally used to do this, guys. Like, this is This is OCD. If I had something, I have this keyboard, right? Let's say this keyboard says it's 24 inches long. I would and so I was looking for the 12-inch area. So I measure 12 inches, measure 12 inches, measure 12 inches. I'm like, I'm not sure that's a simple. I'm not sure that's right. I measure the other side to make sure they met. Like that's how anal I have been in the past. So consilience is when you have different forces confirming it. So when the technicals line up with the fundamentals, line up with the bigger picture stuff, macro, I guess, I'm going to do it. Unfortunately, you have systemic risk. That's another thing. Anyway, that's it. But Britt, let's talk about an idea. Britt, you want to do that? If you wholly subscribe to Michael's idea that it's going to double or triple within 6 months, right? Let's start with that. Let's say we wholly subscribe that it's going to double or triple in 6 months. All right. I'm thinking off the top of my head. I'll have 5 different ways to do it, but this is the first one I'm thinking of. I want to bet on it doubling in the next 6 months. And I want to buy the call that goes at the money when it doubles. And I want to be able to sell the call that goes at the money if it triples, right? So let's say we're trading 50. I want to buy the 100 call, and I want to eventually sell the 150 call. No, exactly. Exactly. Right. That's the problem, right? If you're short dated, you end up paying $1 a day for fucking a million days, excuse my French. Or if you buy long dated, exactly. It's duration versus backwardation in the vol. Yeah, I get it. That's what that's what you're talking about, right? I want to make sure that you know that I know that we're on the same page. Yeah. Okay. Good. So um, I'm giving you what I have given people as ideas. So I'm not giving you ideas to do, but I'm giving you ideas that I would consider. I want you to just say, I'm completely convinced that Michael's right for this conversation. No hesitation. I will put on a trade. And I'm saying it this way because I've had people say to me, I think this. How should I express it? So I'm coming up to Michael and I'm saying, all right, you think that, this is how you express it. All right. Number one, you have to look at 2 things: price. And number 2, the second thing is you have to look at time. So 6 months. All right. I'm not even getting tactical yet. You either buy a call, you buy a call spread, or you buy a hedged put spread. Okay. Hedge put spread in gold, secret weapon of the bull. You want to buy hedge put spreads. So those are your 3 choices structurally. Vertically, you buy a call, you buy a call spread, or you buy a hedged put spread. And the hedged put spread is really good if you understand this stuff. Okay. Now let's start with the call because it's clean and simple, right? I want to buy a call. What should I buy? Well, you can buy 6 months out. At the $100 call 6 months out, number one, that's probably a call that everyone's buying because it's the $100 call, right? Number 2, it's 6 months out, so volatility is screaming high. There's probably a number 3, but I haven't thought of it yet. Number 3, if it happens in 6 months, it might not happen for 5.5 months. So why don't I just buy a short dated option, right? So now you go the other way and you say, let's go short dated. Well, it's not a lot of money. It's not a lot of, what's the word, notional, but it's high volatility and it's a constant tax on me as I buy these. My first, staying with a call only, Britt, my first reaction is, I don't know which one to do. I'll do both. This is what I've done, right? What I'll mean is when you get to that point, you say, how much money am I willing to spend? So let's say I'm willing to spend $10,000 or lose. How much money am I willing to lose? I'm willing to lose $10,000. All right, so I can take $10,000 and buy 6 month out calls at the 150 strike. Let's pretend that uses $10,000. Or I could buy, let's say, 100. Let's use a different number than 100. I could buy 135 6 month $150 calls. Why? Because that's the money I can spend. Or I could spend, it's 6 months. I could spend $1,500 a month for 6 months. You follow me? right? I'm using money because money is ultimately how I spend it, and so that's how I make my decision. So what I would do is I'd say, all right, my now it comes into your style of trading. I'm not going to buy the 150 call 6 months out for me, for my style, because I think the wings are too fat. I have a better way to do it. I prefer to do something else. All right. I'm going to buy, but I'm not that, but that's 135 calls, right? It's a lot of calls, but that's a lot of calls. Maybe I'll do that. Or I could buy an at the money call and get 20 of them, or I can buy a 20 delta call and get 50 of them, right? So that's your horse bet. Am I betting the even money? Am I betting the 3-to-1 odds favor? Am I betting the long shot? I like long shots because they don't have to go in the money to make money. You follow the market, they have a delta, they move. What I'll end up doing is I'll pick one of those 3 calls and I'll put half my money in that, and then I'll put the rest of the money on hold for other technical short-term indicators that confirm, and then I'll buy short-dated options with it. That's what I do. No, not necessarily. No, no, each month. No, no. Not each month by the same expiry. No, I mean buy weekly options every week. I'm waiting for you. Britt, anything? Yeah, exactly, exactly. One position long dated, what's going to happen? It's going to go in the money like after 6 months, and you may even make money, but you have spent a lot of money doing it. Buy them all short dated. And by short dated, I mean really short dated, like 6 days. Buying them all short dated. If it doesn't happen, you end up, first of all, it's time intense. You're going to look at it every day, right? And second of all, you can spend a lot of money before you make money. So I like to. It's not a barbell. I like to do what's called I like to do strips, and strips are buy one every month. Okay. But I don't do strips anymore. What I'll do is I'll buy a 6 month call. You've heard me say this. I'm long 6 month silver calls, and I added a kicker. Same idea. That's how I operate, right? So I'm long 6 month calls because my 6 month analysis says we're going up. And then when I see something happen, I'll buy a 1 week call. Like when I saw the silver stuff going on, I'm like, shit, I overloaded. So that's it. That's my mix. I want an anchor and I want a kicker. That's what I do. And by the way, you still have this great flexibility, Britt. So for example, let's say you buy the 100 call, right? You buy the 100 call and the market moves up slowly. It's not going to happen, but the market moves up slowly from 50 to 56, right? And they're doing okay, but they're not doing much. But then you see a signal that says, well, it's going to move up faster after that. And then you go in and you buy short dated calls, really short dated calls at the money or out of the money. You depend on how you want to do it. Okay? Yeah, exactly. Exactly. Right. Right. Yeah. Also, you could do here's one for you, Britt. I don't want to complicate your life too much, but you understand these, right? So let's say I have my 6 month calls on, and I see the volatility is too expensive for the 1 week calls that I want to buy. So, but I'm really bullish. I'll sell a put spread and buy a call. So I'll collect 20 cents and pay 20 cents. That's called a 3-way. But yeah, what it really comes down to is duration versus money spent. Everything else fits our knobs to fit into that. How much money am I going to spend? How much time do I want to have? Everything comes down to duration and money spent. Hopefully that helps.
Hey Vince, this is Iggy. Just to tie up the Scott and your discussion and discernment as to what happened, what under each scenario, how would you expect the market to react, say, in the next coming days to week or two, under each scenario? Like in other words, what should we look for if it's one thing?
Okay, so let's split the scenarios completely opposite, right? Let's split the scenarios. Let's make Scott's scenario very simply. There is no one capping it. It's macro discretionary selling it because they're selling into strength, and they get to take some profits. Well, if that's the case, then I want to sell. I'm telling you what I want to do. If I knew that Scott was 100% right, I would want to sell rallies. I would not want to sell weakness, and I would not want to buy strength. I would want to sell rallies. So I would expect the market to go up again as the short started to cover again, and then I would expect the macro trajectory to sell into, because when they're making money, they're very sexy, they're very patient. If it's my idea, let's pretend it's completely the BIS, I would also want to sell rallies, but I would also sell weakness, because I would think that the BIS will chase it down, but their presence will make people start to panic. All right. So in both cases, over the next 3 days, I don't think we make new highs. Right. I mean, I could be completely wrong, but I'm just telling you, like, I'm speaking in absolutes, not because I'm confident in my opinion, but because I want to give you definitive answers. If you everything I answer is you put a gun to my head. If I put a gun to your head, Vince, and you had to put a trade on, we used to do these. I mean, this is how we manage risk. If I put a gun to your Vince, what do you think? I don't know. Well, I'm going to put a gun to your head, and you have to tell me what you're going to do, and and you can say anything you want, this, that, but you have to have an answer. So you have to have an answer, right? And the answer is, when you really didn't know, you would say, pull the trigger, because I don't know. Like, if you ever said pull the trigger, your boss will be very mad at you, because you're supposed to know what to do in every scenario. So to answer your question, I'm going to speak in confidence, but it's only because I'm acting like there's a gun to my head. Gun to my head, I do nothing. If the market gets weaker and goes below last week's lows, last Friday's lows, I sell it, because then I think that someone's impatient. And if the market rallies, I do not buy it, and I start to sell it as it goes up, and I only cover myself out above new highs. That's what I do. So I do nothing until the market makes new lows, and then I would sell some. And if the market rallies, I would sell some, but I would always be looking for my stop losses. Like, I wouldn't sell, like, I'm not going to sell gold $20 higher tomorrow. Okay. I'm going to sell gold when it's near the highs. In fact, I would prefer to sell gold making new highs and then coming back in on like a long wick on an hourly candle. So I think the gold market is either capped because I'm right, or going to get weaker because Scott's right. Or you could say, yeah, that's what I think. No, that's what I think.
Perfect. Thanks.
Yeah. All right. I'm going to answer Richard's question, and then I'm going to call it a day. Um, cover the hedge put spread idea. Okay. Forget a put spread. Just do a put here for a minute. All right. Put spread's a different story. I mean, it works, but I just want to do a put because the put spread confuses people. When you look at where is it? Where is it? Hold on. I'm going to draw this. Let's see if I can draw this. Can I draw it? Oh, good. I can use I use that background. Thank you, Randy. All right. Let's go with a color that shows up a little bit better. All right. Are you familiar with options at all, Richard? Okay, good, good.
Yes, I trade options.
Good, good. All right, good. So the reason that you go with a hedged put, it's a put spread, but just call it a put for now. The reason that you go with a hedged put is because the gold market is a stochastic volatility. It's a stochastic volatility market. And the gold market, stochastic volatility means this, everyone. This is where the futures are trading. Okay? These are all the puts. These are all the out of the money puts. We only talk about out of the money options here. These are the out of the money. I need something that draws a little bit better. I'll just do it this way. This right here is your at the money vol. That's your at the money, right? The puts, I'm exaggerating probably, but the puts go like this. 45 delta put, 40 delta put, 35 delta put, 30 delta put, 20 delta put, 15, 10, 5. Okay? On the call side, it goes like this. 45 delta call, 40 delta call, 30 delta call, 20 delta call, 15 delta call, and then it actually tails off. The tails cap because the stochastic process is too much. All right. The reason you buy a put at this stage of the game, at all-time highs, you don't usually do this, is because I do love this trade, by the way. You buy this put right here. Why? Because it's cheap volatility-wise. So you're not laying out a lot of premium. So here's the put. Here's the equidistant call. You follow me? That's a lot more money than that. So you buy this. All right. You hedge it. Let's say it says it's got a 35 delta. You hedge it with a 30 delta. You hedge it light because the delta is wrong, unless you have a really good model. Most of the deltas are wrong. So you hedge it light with the delta. When the market rallies, the stochastic process makes the whole volatility curve do this. The whole volatility curve will go up. Now, your relationship from here to here won't change, but volatility will go up across the board. All right? Now, the reason you only hedged it with 30 delta is because as the market rallies, your option is going to go up in value, or put it this way, it's going to go down less because the 35 delta is really too high. It's really a 30 delta. So you buy the 35 delta put, you hedge it with 30 deltas, the market rallies, you get all the natural gamma, the real gamma of an at-the-money option. And we're moving away from the option, right? So you're not dependent on people wanting to buy it. We're just moving away from it. And the futures just make you money as it rallies. It's a beautiful thing. What's the flip side of that? Well, the flip side of that is if the market drops, you're not long as many futures against it. Because as the market drops, what's going to happen to volatility? It's going to come in. So the volatility of the 35 delta option on the put side, if the market drops, that put will actually underperform on the way down. Every dollar it goes down, it should go up by 35 cents. Well, it's only going up by 30 cents. It's only going up by 30 cents, right? So for the first wave of the market lower, you'll be okay because you have less of a hedge. You with me so far, Richard?
Yes.
All right. Here's the kicker. Because we're trading, this is why the all-time highs is why you would do this. Because we're at all-time highs, if the market drops, it's probably going to drop more than $100, right? So your option won't be just an option that kind of has a shitty delta to it. It'll actually go in the money. Your gamma will be realized. On the upside, when you're at the extremes of vol like gold is right now, when the market rallies, volatility doesn't come in anymore. You'll see it in your shorter dated options. When a meme stock has it, the market will rally. So volatility gets to, let's say, 100%, 99%, right? The next $10 higher in gold, the puts will go up as the market's going up because their deltas are so small because the volatility is so much more important. So the secret weapon of a gold bull at new all-time highs is hedged puts. The reason I say hedged put spreads is because hedged puts, you could trade the gamma around. Hedged put spreads, I would say to someone who's not a gamma trader, do a hedged put spread, you lay out a little bit less money, and you let your profits run. Does that help?
Yes. Thanks.
All right. Guys, I'm out of here, unfortunately.
Thank you, Vince.
Yeah, who did I miss above me, like on these things here? Is Arena here? No. I don't have my pictures open. Let me open the pictures up again. All right, so
Hey, Vince,
yeah,
you've got a lot of Brits now subscribing to Goldfix.
yeah.
I hope you're hedging
True.
your cable.
I hope I'm what?
I
Hedging my
hope you're
cable?
hedging your cable.
Yeah, you know,
Goldfix is
well, yeah.
sterling fee income.
Well, I'm thinking about taking a vacation there because, you know, I mean, I got to spend the money, right? I got to spend the pounds. Well, actually, Scott, nobody's listening to this, just you and me, Scott. Scott's like the token British Jew. Now I've got like 5 more guys, and he disagrees.
Hey,
with
I'm
me
a British
He
Jew.
disagrees with me all the time, and he's right. I can't have that. I can't have that. Oh God. Right? Well, that's because London has no silver left. Or LBMA.
Huh?
You're coming to the Yanks for the silver now. We got you. All right. Wow, this is a big crowd. I'm sorry if I missed anyone's questions. I know that I can be, a little bit scatterbrained on stuff like this. Let me see. Is anyone here? Well, I want to say hi to every one of you, but there's a lot of people here, so I'm just going to say hi to every one of you, not individually today. And that's it. I mean, I hope this was good for you. I hope you got something out of it. And I'm going on the record as being bearish. I'm going on the record as saying China might not sell tonight, even though they sold last week on last Thursday night going into Friday. China might not sell tonight, but I think rallies will be sold. That's really where I am. But look, you had a big bearish candle. Who wants to trade that? Maybe sell new lows. That's it. Uh, have a good day, Matt. UK is going to get cheap for you guys. Fish and chips, man. I want to go. I want to do the tour. I want to go see Madonna's British house. Just kidding. All right, cool. Nobody took the under on 4 p.m. today. Wait, I got to get off before. Oh my God, my phone's going to ring any minute anyway. Guys, have a great night. I'll throw this out, and I will add an excerpt from Michael Oliver, so you can get some gold levels. All right.
Have a
good
good
night.
week. Thank you.
Yeah, thank you. Great stuff.
Shut up, Matt. Bye.